So the topic today is a very important topic. As Saudi Arabia's real estate market has entered a period of unprecedented transformation, driven by Vision 2030, public investments, and evolving investor appetite. Today, we'll unpack how these have shifted their translating into real estate across the real estate sector segments. I am joined today by 4 exceptional readers who will bring different vantage points from across the investment ecosystem. Please allow me to introduce Mr. Ibrahim Alalwan, Managing Director for Watheeq Capital, Mr. Anas AlDowayan, CEO of AlDowayan Holding Company, Mr. Abdullah Kamel, CEO of Woroud Real Estate Development Company, and Mr. Mohammed Arab, Group CEO for Arab Group. Would you like to please introduce yourself and tell us what you each do?
Thank you for the introduction. And my background actually both in real estate development and at the same time the investment side. So I always seeing the real estate in both sides. I have different hats sometimes from as a development, sometimes as a investment advisor, or let's say asset management. I spent like the last 25 years my experience in real estate, especially. I start with the financing, from banking, then investment banking, then real estate development. Then I come back to investment banking as a fund manager. Today, I focus on my own company. It's Watheeq Capital, which is an investment bank regulated by CMA. So we focus more and more in different area, but we return back to the real estate is the most important. We invest in property, something related to real estate. However, our main target usually to focus on real estate. We have for the last year we launched 4 real estate funds in Saudi. The size of these funds around 3 billion Saudi riyal. We just recently starting with the real estate, but we have private equity, venture capital, but most of our focusing in real estate. I don't want to give more time or talk about more about my background, but at least this is the nutshell.
Thank you, Ibrahim. Anas, would you like to give us a brief introduction, please?
Thank you so much. It's a pleasure to be here today. Thank you, Suzanne, for the introduction. My name is Anas AlDowayan. I came from a different backgrounds, from real estate development and the real estate advisory and valuation and investment banking. And today I'm talking about the development arm, which is, I'm the developer here, one of the developers. I mix all of those experience to help the development to be more innovative, more into the growth, how to use the financial models and structuring to help growing up the business and bringing accommodate the Vision 2030 ambition on the real estate side. Right now, in AlDowayan Holding, we are managing around 5 billion riyal portfolio between mixed development or mixed-use developments and shopping malls and residential complexes and infrastructure. And right now, we are growing on those 3 sectors with the governance in the board and in the regulations. And we are moving also into the IPO within the next 2 years. This is mainly what we are doing, and I hope we can add something today. Thank you so much.
Inshallah. Abdullah?
Yes, assalamu alaikum. My name is Abdullah Kamel. I'm the CEO of Woroud Real Estate Investment. Woroud is a real estate investment and development firm. Historically, up until last year, it was focusing on raw land subdivision and sales, master plan development. And since last year, we have approved a new strategy to focus on superstructure development. We're focusing on Riyadh, Jeddah, and Medina. Of course, we're selling off we're still selling our 6 million meters squared of raw land subdivisions across Riyadh and Medina. But sectorially, we're focusing on hospitality, mixed-use developments, residential build to rent, and geographically, we're focusing on Riyadh, Jeddah, and continuing our focus in also Medina al-Munawwara. That's in a nutshell of what we're doing.
Thank you, Abdullah. Mr. Mohammed.
Thank you, Susan, and thank you all for being here today. I'm so glad to speak and share some of the thoughts today with you and speak a little bit about our company and our exposure in the market. Actually, unlike the gentleman, I'm not especially in the real estate. We actually run a diversified portfolio in multiple assets, but we do have an exposure in real estate. Alhamdulillah, we have an exposure in real estate from the infrastructure all the way to superstructure. We usually have, we used to be known as a very good arm in raw lands. We developed more than 100 million square meters across the kingdom in Riyadh, Medina, Al-Qasim, Jeddah, and Mecca as well. And also, we have a development company specialized in building towers. And right now, alhamdulillah, we have 6 running projects among the kingdom in Mecca and Jeddah and Riyadh and Medina as well. Also, we do have exposure in the real estate marketing. We have a company that have license and do all the marketing activities, starting from direct marketing all the way to making auctions. I am happy to share my thoughts here with the gentlemen and with the presence of such a nice firm as Knight Frank, and thanks for the organizer for organizing such an event.
Thank you, Mohammed. So let's start. Ibrahim, as someone involved in the capital markets, could you please paint us a picture of how returns have evolved across Saudi Arabia's key real estate asset segments? And also, what are investors prioritizing today? Is it rental yields, capital appreciations, or long-term value creation?
Yeah, when we talk about return on investment in real estate in Saudi market, actually we have to see historically how it was and how it's improved during the last years. Especially with the changes in the Saudi market. In the past, people focus, or investors focusing more and more on land construction and what's the return of these 2 items. Also, they think about short-term, mid-term, but right now we can see how the markets change, especially that different players coming to the market, institutions coming to the market. For sure, BIF changing the land place for the investment in real estate. They changed all the rules. So even with the private sector starting to change their mind, how they think about real estate. So right now we can see the movement from just thinking about land and construction and what's the return, focusing more and more in how we utilize financing and also the operation. And I can just explain a little bit about that. In the past, most of the projects financed by equity. Right now, most of the projects combining different way of financing projects, from equity, from debt, from off-plan sale, from different way of doing financing to these projects. And with this way of financing projects, the return also change based on that, and also the competition change based on that. In the same time, when I talk about the operation, even the projects, we just not talking about buildings or just to have a building. Sometimes we add value to see the return. When you talk about, let's say, the lifestyle in projects, how to add value to projects from a return perspective. So we can see developers change the way how they operate their assets through adding value, let's say, different components of real estate, having mixed use, so each components adding to others, which make the return, even with the competition from the market, so they can increase the return as yield based on what they provide in lifestyle or the combination between components from, let's say, residential or offices or, let's say, commercial. So all these components, when you operate it in a good way, so the return will be changed. This is the way how we start to think about the return and real estate in Saudi market.
Thank you, Ibrahim. Would you like to add anything? Do you have any different point of view, Abdullah and Anas Mohammed?
Yeah.
So which segments are currently delivering the most attractive yields in your opinions, and what are driving these results?
Yeah, from my point of view, I think if we talk about the segments, as per our portfolio, I can see the surfaced residentials showing higher yield, especially over the last 2 years. There is a high demand on the surface from the visitors, from the transit visas, and because a couple of events, couple of projects, especially in the Eastern Province and Riyadh. On the second row, or in the second rank, I think for us, as our portfolio, the shopping mall is showing also a good return, a good yield. And on the third rank, I think outside of our portfolio, I see some of the warehouse sectors, like the cold storage or some specialized warehouses, is also showing good yield, but it's outside of our portfolio. This is, I think, is...
Yeah, I would love to add to Anas. I'm sorry for interrupting, but also I would like to add to Anas. I think it's geographically dependent. So if you speak about Riyadh, definitely you can see the rental yield is really attractive there because of the growing demand, and Riyadh have now lots of seasons and lots of events all the year. But let's look at Mecca or Medina, for example. Here you can look at the equity story more than the yield story. Still the prices in in Mecca and Medina and some other places, Qasim, for example, Taif as well. Still the prices are lucrative. You can build on that as an equity story. But in other places, I think it's really hard to build an equity story. So I think it's different geographically.
That's correct. So Anas, as a developer, how are you adapting your project strategies to meet those evolving expectations on returns? And where are you finding efficiencies or value opportunities that preserves ROI?
As a developer, I'm receiving the ROI for the developer, for the landlords, and for the funds.
Yeah.
I'm trying to maintain my cash flow, to be honest. Definitely, there is also a couple of things that really matters and really affecting. As a developer, we are building the equity story. We are building a momentum of development. We are building an engine that really can deliver more than just make a cash-on-cash return every year or IRR. Mainly, the free cash flow is matter too much, especially with the contractors. If we talk about the following up on the cash flow and the installment, restructuring the deals, the interest rate and the financing, re-engineering is always matter. I think it's really not only the normal metrics that use for anyone can fits the developer. The developer always trying to convince a couple of stakeholders in the whole development story. And the beauty of development, you are a service provider at the end. You are not so much capital intensive. I know the development it's a heavy cost on the labor side or the capacity and the resources, but still not so much capital intensive. If I talk about just 3 projects in my mind. I compare the return for the investor and the return for developer. Definitely the developer making a minimum 50% more than the investor, because the monetized cash is, or the monetized capital is a way smaller than what's been. If we talk about a developer getting, let's say, 10% development fees out of the whole project, he takes this out of his cost, out of his contributions, not necessarily a cash contributions. And even some developer, they in-kind their own benefits on this. I see it's so much rewarding for a good developers. It needs to be a quality developer, definitely, to make this good returns. This is from my side.
Thank you, Anas. This is great. Abdullah, from your vantage point, how are investors balancing short-term rental years versus long-term capital appreciation? And whilst working across multiple asset classes, are you seeing more appetite for institutional capital, or are family offices still leading the charge in Saudi real estate?
In terms of balancing investors' appetite between searching for the short-term yields and long-term capital gain, I think it differs from investor to investor. Basically, some investors, real estate investors, like capital deployers, have a strategic asset allocation. So each investor has a different minimum return and risk appetite. And depending on that, a certain portion of their portfolio is opportunistic, high-risk greenfield developments, and a portion of that is safe, income-generating assets, acquisitions of safe income-generating assets in primary cities. And so it depends from investor to investor. Endowments, sovereigns, and REITs are looking for safe, core submarkets, core asset classes, delivering yield, whereas other investors are, especially retail investors, are investing through funds in more risky developments, greenfield developments, looking for the capital gain return. And in regards to the second question about institutional investors, I think there's been a huge growth in actually institutionalizing the way people invest today. So a lot more people are more prone to investing through fund vehicles because it's introducing overnight governance. There's a board overlooking all major decisions. It's a clear business model. You're going to develop, operate, stabilize, and sell, and all investors get their money. And the fund managers are usually aligned with the LPs and the investors because they have a carried interest that they wanna achieve. So I think, and real estate developers now are actually preferring to work with fund managers, because even the debt terms that you get from a fund manager is much more preferable than just issuing debt at an SPV level. Banks are more prone to giving good terms to CMA licensed fund managers. So yes, in short, I think institutional capital is growing a lot. I think I remember I was sitting down with in an event, and I was listening to the governor of the CMA talking about how in 2021 real estate funds represented 50 billion riyals in 2021, CMA licensed real estate funds, and it grew to more than 280 billion by 2023. So it's almost more than quadrupled, yeah. So yeah, I think institutional capital is growing a lot more now than family offices. Family offices are investing through funds and they're preferring it as a vehicle.
Correct. Would you like to add anything?
Yes, actually, it's interesting, really, how Anas is saying, what I say saying about how the developer seeing the return on investment in real estate. At the same time, when Abdullah said talking about shifting from, let's say, investing directly through institution and funds, and this is really what is happening right now in Saudi market. That each, let's say, a player doing his role. Let's say a developer thinking about, okay, right now I'm a developer based on fees, development fees. This is my exactly the main return on investment. and keeping their investments through funds or different way of investment. So they segregate between the investments and development. So because sometimes if you mix it together, you don't know exactly what's the return coming from the investment or from development. So as you, Abdullah mentioned that starting having institutional funds, and even with the funds, you see different kind of risk involvement, which is also associated with the return on that. So people, or let's say investors, will choose their own, let's say, return and risk involvement.
Anas, were you going to say something? Okay, sorry, I thought you were going to say something. Well, thank you. You both highlighted how investors are reshaping ROI strategies. Let's discuss how this fits into the broader ecosystem or the bigger picture. Mohammed, how do Vision 2030 giga projects and mixed-use developments shape national confidence and returns in the wider market? And do you think these projects are concentrating opportunities on giga project zones, or are they creating positive ripple effects throughout the kingdom?
Yeah, okay, thank you. Nice question, Susan. Actually, the Vision 2030 has one of the biggest advantage on the Saudi market, which is putting the big broader lines and showing the vision, showing where are the areas to be concentrated in. Actually, it also shifted the attention to new markets. For example, tourism. We were not that active in tourism before the vision. Now we are expecting more visitors every year, and now we are having visitors more in every year. In Riyadh, for example, we have a very big shift in, let's say, across Riyadh region as well. Now there are some areas in the south due to the southwest due to Al-Qiddiya project, one of the giga project, also the North Pool, that enhance, not just enhance the prices of the lands, it also enhances the attention and the concentration of developer and capital market to invest more in these areas. I think also because of the ambitious theme of the vision, it encourages the developer and the landlord to come up with new creative ideas. Now, before, who could imagine that a fully driven project as of Manhattan Land, the one was operated by Dar Al-Arkan in alliance with the Dar Global and Trump Foundation. Who could think such a project costs more than 15 billion land and construction value to be driven fully from the private sector. Another area that was highly focused by the new vision is to invest more in the tourism in rural area, or the places like Al-Ula, like Hail, and other places. So I think Vision 2030 did shifted the market. Also give an ambitious theme to people to invest more in Saudi. Now we are expecting expat to also to have a new entrance to the kingdom that will raise the FDI, that will also create more opportunities, create more, let's say, creativity to the market in order to attract those investors. So yeah, I think the vision reshaped the market and put it in a new level.
Okay, so this is a question to all of you. How do you see the concept of returns evolving beyond purely the financial and moving toward value creation based, for example, through long-term placemaking, ESG, innovation, and social value?
I think in the past, the people or the investors just thinking about absolute numbers and the return. But right now, with let's say the new players, especially with the giga projects, or let's say the main developers right now from BII, if they start to introduce, let's say, different, let's say, tools or measurement to see the return on the community and the economy. So for sure they are the leaders. So when they put it in the therapy, we just think about the return on investment as absolute numbers. They think about how it will add value for people, for the lifestyle, for the whole economy. Even with the whole economy, sometimes the return is not only just on your project's return on the whole community, which adding value to each other. I think most of these measurements starting, especially coming from the let's say the master developers, which is belong to BIF, is the most. But right now, I think it's coming to people will evaluate projects, not just only think about absolute numbers. They have different, let's say, way of measuring their impact on the society and the environment.
Thank you, Ibrahim. Anas?
Differently, it's a multidimensional. Return that's happening right now. There is no one singular return calculated, definitely, as you just mentioned. ESG matters today, not like any time before. Even the audience right now is different, stakeholders. Saudi is different today. Everyone's different. The social value return is so much affecting the projects right now. We're talking about supporting local SMEs, walkability, livabilities, elements that really increase the long-term resilience and create competitive differentiation is really matters. You talk about also the place-making driven returns, projects that really enhance community engagement, increasing the footfalls, strengthening the long-term asset stability. Right now, what we can see in the codes, in the TODs, in all the incentives that brought it to enhance the quality of life and how those things really matters. Anyone can imagine Riyadh before CAFT or Riyadh before the Kingdom Tower or Riyadh. Any real estate component is really adding too many dimensions other than the return. Thank you so much.
Abdullah?
In terms of adding value, taking priority sometimes over just the best returns. So institutional developers now, historically Saudi Arabia was a very fragmented market. There was no singular name like I'mar, or in Egypt you have maybe a minimum of 12 of the top developers. Saudi Arabia was mostly independent, single offices developing independent developments. And historically, developments were concentrating and focusing on the shortest term, highest yield, and there was not a lot of thought put into, like you just mentioned, maybe compromising a bit of return for a more long-lasting development with sustainable returns. So, as an example, I wanted to mention, so we are developing now. Two of our projects are mixed-use projects. And you put in your financial model each and every component. You have a hospitality component, retail, and maybe office. And the hospitality, and we do a component analysis. We see how much each component, with its required parking, with its portion of the common areas, all that cost, how much is it contributing in terms of returns to the overall project. And you'll see that sometimes the hospitality component is actually dragging your returns for the overall project. But the externalities of that component is what will make your project much more sustainable, a generational real estate asset that generation after generation will be there, and all it takes is upkeeps and upgrades, and the property can continue for many years. It won't become obsolete the moment my neighbor develops another development. So I just feel like the way now, today, developers are starting to look at the externality effect of that component. Yes, my hospitality component might be dragging on my returns, and the office parking requirements are so high and it's dragging my returns, but the office employees are eating in my retail F&B tenants, and they're it's becoming a self-sustainable community. So I just think that institutional developers today are looking at that externality effect.
Yes, absolutely. I can't agree with you more. Mohammed?
Yes.
Well, we're almost running out of time, so let's wrap up with a quick round of rapid fire insights from you. In few words, what does built for returns means to you?
I think it means creating value. Built for return is creating value. How you can make from multiple components in real estate, you come up with the value. This is what I think.
Anas, what does built for return means to you?
Maintaining a good yields for today and incurring for tomorrow, and keep going with the growth, because it's not easy. The cost of development it's going up, and you cannot afford to live with the same yield. You need to bring another level of quality also.
Yeah. Absolutely. Abdullah? Sorry, Anas. Sorry, Abdullah. Abdullah.
Build for returns could mean different things, but
To you, what does it mean to you?
to me, it could be either building for the yield of the project, or if you're a different type of investor, it could be building for the capital gain of the project. But I think building for yield will eventually give you the capital gain, actually. So building for a right yield.
Thank you, Abdullah and Ibrahim.
For me, actually, it's the sustainability. That mean, because building is not something that you build it today and you can remove it tomorrow. So you have to build something, give you a very long, as much as possible return in the future. So you have to build for sustainable return.
Thank you. Thank you, gentlemen, for joining me today. And I hope the audience enjoyed this panel. And we look forward to joining you down there.